Hello everybody and welcome to all. Tom Daly here from the Academy of Financial Trading. We are about to begin your 9th lesson as part of your foundation trading program. This evening's lesson is crucially important because we will be focusing upon risk management and profit maximization. So how we can use risk management methods to not only protect ourselves and to also generate and secure further profits. And an exceptionally warm welcome to all our newest members of Show Academy. We're so delighted that our offer has been received so well, and we're delighted to welcome you all aboard for a long future together. As always, guys, what we will do is we will start out by having a look at our risk warning. It's particularly fitting given the fact that we're going to be looking at risk quite a lot during this webinar. So let's start out and let's have a look and define what the topic is. When we speak about risk, it is the possibility of loss. If you were buying a particular market, the risk exists that that market might fall and you would be in a losing position. If you were short selling, the risk always exists that the market might rise and you could again suffer a loss. Guys, do we think that risk is avoidable? Could you entirely avoid risk in financial trading? What do we think? Let's use that chat again. Let's see, Michael and Albert and Rosanna all saying no. Just about everybody is saying no, you cannot entirely avoid it. Neil, you might be on your own. I guess risk in trading, I get it. Jayant and somebody else I think has typed in, yes, it's avoidable if you don't trade. Absolutely. Well, when it comes to trading, risk, like most other things in life, it cannot be avoided. It can be managed, it can be protected, but we cannot avoid it. So when we look at the realities, we say that if we're going to have to deal with risk, you must understand it as a creature. And that kind of leads us on to the next question. And that question, going out to all of you guys this evening, is whether or not you believe that risk is 100% good, or do you think it's 100% bad? Or do you think it's a bit of a combination even of both? What do you think? Do you think it's all negative? Do you think it's all positive? What do you guys honestly think? Is it all negative, all positive? You're saying a combination. A lot of people saying combo, Judy as well. Most people are saying 50-50, must be both. Absolutely, it must be a combination of both. That's a fair point. Because if there was no risk, there would be no opportunity for return. If you look at risk in any other area, like what is the type of cuisine that you like eating? At some point you had to go out and take a risk. You had to taste it. You had to see if you were allergic to it. You had to see if you liked it. When we talk about sport, we take risks all the times. If we as human beings, if we didn't take risks, we wouldn't have the type of society which we had today. Nobody can actually really live in a cave. Well, somebody can live in a cave, but nobody really wants to live in a cave, I don't believe, do they? You want to see the bigger, brighter world that is out there. We can't really afford to just have that isolated viewpoint. So the purpose of this evening's lesson is to help you to stop losing money. We view what we do as a bit of a crusade, as a bit of a mission, if you will. If we achieve nothing else, absolutely nothing else, other than to show you the truth about trading and the realities which exist, we feel that we have achieved our objectives. Because it's far too often that people come into the world of trading and they might expect instant and ridiculous gratification and massive returns. And why people expect that is because of all of the advertising budgets that all of the brokers are pushing and are using those budgets to push the same message. The idea of huge gains. So what we want to do is we want to say that absolutely the results can be good, but you must know what you are doing. You must protect yourself. And if you start from that perspective, if you're constantly focused on protecting yourself, you will be in a much better position. So let's start talking about managing this heading, about taking control of it. Essentially, you're viewing risk like it's an individual, or like it's even an animal, if you will. You're trying to harness its strength. You're trying to protect it. But all the time you are conscious that it is an animal and it can change. So what we are looking at is this exact area. If we stop focusing on generating a return, if we focus instead on preserving that which we already have, the rest is much more likely to follow. And this does sound like a bit of a fluffy, conceptual point without meaning, but it's not. Because if you're looking at the financial markets, if you protect yourself every single time a risk develops, you will have the financial resources available so that when you are right, and you will be right at some point, so that when that event occurs, you have the capability or the financial resources to take advantage of it. And, we've all been there. Has an opportunity ever come your way, whether it's buying a particular vehicle or buying a property or whatever the case may be, but you didn't have the capital to proceed with it? If you had the capital, it would have made a profit. You see, the exact same is relevant in trading. You can be the best trader in the world, but if you've got no capital to actually trade with, there's nothing that you can do. So the issue is that we must protect ourselves at all times. We overcome these headings. We accept that loss can occur, but we preserve ourselves. And when we speak about risk management, what is crucially important is to understand some of the maths behind everything. So we're going to go through these headings just to make sure we're all fully comfortable. We say that risk and return are absolutely linked. They're inextricably connected. And we say that we have to understand what the possibility is. What is the probability of a particular event occurring? Because how you will manage each scenario will be different dependent upon how likely it is that it might happen. And what we're also going to talk about is that we do not know how much might be appropriate, if anything, for you to trade. Okay? We don't know how much in a monetary sense is appropriate at all. Okay? We don't know on an individual level, we don't know on an overall level. So what we are going to do is we're going to speak about things in a percentage sense. And then you will hopefully be able to figure out the remaining headings. The major point is from that comfort perspective, if you would be wholly uncomfortable in leaving your trades unattended, that's a sure sign that you are taking too much risk. So this comfort issue, if you couldn't leave your trades for 5 minutes, if you couldn't leave them for an hour, that's a surefire sign that you are over trading and you've got too much risk sitting there. And speaking about this a little bit further, I know that a lot of participants on this webinar that you've reached out to us, to our support team here in the Academy, and you've asked, how do we go about developing a trading strategy? Just out of curiosity, guys, has anybody on this webinar, have you already got your own trading strategy? Are you using something that you're in any way confident in? And it's normal if you haven't, don't worry. Most participants are typing in no, not a good one, Marty, that's okay. Robert, I can see you've popped in yes, that's brilliant. What else have we got? Dieter, you're saying yep, brilliant stuff. Basically, a trading strategy is you knowing what to do in the market. Okay, you knowing what sort of entry to take, what sort of exit to take, what sort of stop loss, whether or not you want to place a limit, maybe the size of the trade, maybe how many markets you want to trade. All of the possible variables that allow you to make a decision. Everything. Basically, a strategy is a trader, if you will. It allows you to make all of the decisions. People ask us then how long it might take to actually develop a strategy, and it can take several years. It certainly takes quite a lot of experience, but let's talk about how that occurs. Okay? It starts out with a very simple idea, like most things. Why do you think there might be an opportunity based upon some certain set of facts? And what our idea was, is hopefully really, really simple. Our idea was that market makers and institutional traders, they make huge amounts of money. And that's it. That's our basic starting point. Market makers make huge profits. How do we know that? Well, many of them are public companies, and you can actually check them out for yourselves in terms of their profit margin. So then we ask and we say, well, what's the next step? And the next step is that individual traders or retail traders tend not to do well. And that's probably one of the largest understatements of the year. Okay? So we have two ideas there, and they're both fundamentally connected. The individual tells their broker where the stop loss is, and they wonder then why it gets hit all the time. So we have these ideas. And then what we say is, well, having come from the market maker industry, the brokerage industry, and having traded our own funds, why don't we just operate like a market maker? Why don't we just figure out when the individual is trading, or where he is trading, or how he's likely to trade? And then we can use them as bait in order to trade like the market maker. And that's exactly what we do. A retail trader, Graham, it's just a normal day-to-day home trader. Somebody who's just hasn't a great idea of how the markets work, and they're just spending their own time just sitting down trying to trade against the larger entities. So that's a simple premise. So what does a market maker do? Okay, when a market maker is managing their book, when they're managing their own positions, what they will do, from a conceptual sense, they're trading with momentum. What they'll do is, if an individual trader is losing money, the market maker will do nothing. So imagine an individual trader is losing, the market maker will do nothing, will say, that's great, because every loss of the retail trader, the broker, the market maker is going to realize that opposite profit. Now, if a trader is winning, okay, and if that gain is so large as to pose risk to the market maker will then generally go out and they will clear in the market. They will hedge, they will take off some of that risk. Now, what does this fundamentally mean? It simply means that a market maker, they shut their losses quickly, okay? But they never shut a winning trade from their perspective, okay? So conceptually, the market maker just gets rid of risk quickly and lets their gains, their profits run forever. Does that make sense? So that's our logical starting point. That's our initial assumption. Why don't we find ways to get risk off the table quickly and to let our profits run? It's one of the oldest, one of the more classical styles of trading that you could possibly use. So that's exactly what the modern brokerage industry is built upon. So we start out with this and then we go and backtest. So we test and we test and we test and we crunch the numbers. And when we crunch the numbers, we get a percentage accuracy level. And then we can develop our risk management strategy. And then we can go and we forward test. And then after all of that, we end up with a relatively fair accuracy level. Does that mean that a strategy or any strategy which we use is 100% accurate? Absolutely not. Does it mean that we get it right? It sure does. Okay? But what we do is, when we get it wrong, we never get burned. We stay alive and we take our opportunities as they appear. And that's, I guess, maybe just a bit of a feel for how one could go about developing a trading strategy. Buying a market on a moving average crossover, that is not a trading strategy. Buying a market because an oscillator says it's overbought or oversold, that's not a trading strategy. There is a lot more to it. Okay? So that's putting everything into context. Let's talk a little bit about what sort of risk and reward ratios one could have within their trading strategies. So there are positive risk-reward ratios and there are negative risk-reward ratios. And before we go any further, we really like positive risk-reward ratios and we're going to explain why that is the case. Okay, so let's talk about these positive risk-rewards. This basically means that when you get it right, you make more money than when you get it wrong. What do you guys think of that? When you get it right, you make more money than when you get it wrong. What do you think of that in an overall level? When you get it right, you make more money than when you get it wrong. Yeah, it's logical, absolutely, Brian. It's the best case, it's comfortable, it sits well with us, it fits well, it feels like it's the right way to do things. And that's good. because you need to feel comfortable with what you're doing. You don't want something which is trying to overcomplicate an uncomplicated situation. Okay? So let's look at this. Let's say that you aimed to make $150 every time you got a trade right. And for the purpose of these examples, we'll talk about dollars, but it could be pounds, it could be euros, it could be anything. But let's imagine when you get it right, you're looking to make $150. And let's imagine when you get it wrong, that you don't want to lose any more than $50. And maybe that's the case for any number of reasons. Maybe it's because if you lose more than 50, you know that you're going to lose money overall. Okay? But let's imagine that that is our positive risk-reward ratio, the exact dynamic between the profit and the loss, 3-to-1. It could be any ratio. This one is 3-to-1, but it could be any ratio at all. Now, what this really means, if we step back from it, this means that you don't have to be highly accurate. Does that make sense to everyone? You don't have to be highly accurate, because when you get it right, you're making so much more than when you get it wrong. So you don't have to be right all the time in order to make money. Okay? So let's go through this. Let's go through some home truths about financial trading. Some of the greatest traders who have ever lived, who have ever walked on this planet, who have ever put an order into the market, were less than 50% accurate. So some of the greatest ones ever were less than 50% accurate. But they have made huge fortunes. Now, if they were less than 50% accurate, do you think that you, as the new and as the probably not yet profitable trader, do you think that you're going to come out and be greater than 50% accurate? Straight away, after the next webinar, you finish off your training, you say that you're going to go out, you're going to risk your money, I'm going to go wild. Do you think you're going to be greater than 50% accurate? Honestly, what do you think? No, you're right. You are certainly not. Now let's rephrase the question. Do you think that you need to be? Because that's a totally different question. You certainly do not need to be. So why don't we just accept that we don't need to be greater than 50% accurate? Honestly, I couldn't care less about how accurate I am as long as I'm making profit. Okay? I couldn't care. I don't need to feel good about the market. I don't need to be 70% accurate. I don't have those sorts of trading insecurities. If I'm profitable, I'm happy, and that's it. So the issue here is that the nonsense which exists online about 70 and 80% accuracy strategies, we're going to show you one in just a few minutes which shows you how ridiculous it actually is. Positive risk reward fits well. Let's run through an example. Let's imagine that you have a strategy which is 33.3% accurate, and every time you get it right, you make $150. Every time you get it wrong, you lose $50. And anybody who knows anything about Irish accents will appreciate how difficult that sentence was. That's an Irishman's kryptonite, but let's go through it. So let's say that you've got a strategy which was right 1 out of every 3 times. How about that? That's a little easier. And it's giving you $150 every time that you get it right. Let's say you had a perfect sequence of trades. If you had 3 trades coming through in a perfect sequence, how much would you end up making or losing, guys? What do we think? How much would we make or lose? So we win once and we lose twice. What would we make? Or what would we lose? What do we think? In that scenario, if you are right, you would make 150, then you'd lose 50, then you'd lose 50, so you'd be net profit of $50. Does that make sense to everyone? You're up once, you're down twice. If it's a perfect sequence, and that would end up with you seeing a profit. Great stuff. Okay. So if you've got a 1 out of 3 accuracy in this scenario, you can still make a profit. As long as you stick to the plan. Okay? Because if you were to deviate, if you were to take a profit a little bit too early, if you were to let your losses go a little bit too long, you could lose money. Okay? So a positive risk-reward ratio, it allows you to profit and it doesn't acquire you to be more than 50% accurate, and it's a more logical approach to us all. So let's talk about a negative risk-reward ratio. A negative risk-reward ratio is when you as a trader, you consciously decide that when you get it wrong, you want to lose more than when you get it right. How does that feel? When you're wrong, you're going to bleed heavily into the market. And when you get it right, you're going to make a little bit of money. How does that feel? What's that one like? How does that one feel for size? When you get it wrong, it's going to feel like a train has hit you directly in the face. When you get it right, you're going to make a little small gain. That's not how it's going to be marketed, though. That's not what they're going to say to you. How they're going to market it is with some really masculine wording. And what they'll say is that it's a 90% accuracy strategy, okay? And they might put a picture of a fast car or private yacht or whatever the case may be, because we're all that naive, aren't we? So they'll put 80 to 90% accuracy on it, and that's the way it'll be dressed up. They won't talk to you about what happens when that losing trade occurs. They won't talk to you about how that is structured. But let's do a quick example of this type of strategy, will we? We can just draw it out if you guys would like. Okay, let's do it. So let's say if you had a strategy where you were looking to make 10 pips every time you get it right, okay? Let's say you're looking to make 10 pips every time you get it right, which is pretty much what all of these bad strategies look to do. They're looking to make a very small profit because they're probably on a broker deal or something similar. So they're looking to make 10 pips every time they get it right. Okay, so that is profit. But they put a stop loss on that is 100 pips away. Okay? That's your stop loss. So in a normal sequence of events, could we all see that it's more likely that you'll hit your 10 pips profit? Could we all accept that? It's more likely to go 10 pips in favor rather than 100 pips against. Does that make sense? One is much closer to the other. Does that make sense, guys? So that's on that normal sequence of events. Okay, that would be a reasonably high accuracy level. But the issue is, when you get it wrong, it's really going to hurt, isn't it? It's really going to hurt. So this type of strategy, as we've said, it's basically anything that they say is high accuracy, by and large, it's reverse risk reward. That's how it's high accuracy. It's giving it more room to fail. Okay? And nearly every retail strategy out there which exists works in this way. So let's say if you had an approach that was 66.6% accurate, and every time you got it right, you made $75. Every time you got it wrong, you lost 100. That would give you a scenario with 75 plus 75 minus 100 gives you $50 profit. That's 66.6% accurate. So conceptually, they can indeed work. Absolutely. Okay, from a very conceptual standpoint. But let's go through it a little bit further. What we have with this accuracy level is if you deviate once more ever so slightly, it can get quite dangerous. And it can get quite dangerous quite quickly. If you widen your stop loss, if you grab your profit off the table a little bit too early, that's all dangerous. So let's look at the two of them, relatively speaking. The positive risk-reward ratio, we would believe, it conceptually just fits better with us as humans. And when you're in a working environment of any capacity, if something works, you try to figure out why it works and you just do more of it. If something doesn't work, a point must be reached where you just accept the reality that it failed. It mightn't be easy to do, and by no means would we encourage accepting failure, but at a point you've got to shut it down. You've got to cut your losses. And that's in a working capacity. It's the same in a human capacity. It's also true of trading. If something works, you do more of it. If something doesn't work, you figure out why, but you shut it down. Okay? And that's what a positive risk-reward ratio allows you to do. It allows you to remain human while trading. And it fits well, and it sits well, and it's just comfortable with us. Negative risk-reward ratios typically are designed in the wrong way, because they're designed by a marketing department sitting down figuring out how they're going to sell more of their product. So that's the issue that we have a problem with. That's no way to start any trading strategy. It's just the wrong approach to start from. They're trying to package it so that it sells. Whereas we would prefer to just have something which works, and you guys could sell it for us by telling everyone. That's just a more comfortable, a more sustainable long-term direction. So this idea of giving you something to make you feel good, which might appeal to the masses, that's just the wrong angle. Okay? And if we look at it a little further, we can ask ourselves, why is it wrong? And let's imagine this type of scenario, okay? Let's imagine that you had a strategy which was, let's say, that 90% accurate. Okay? You go out, you can go, I don't know, onto one of those online resources that is quote-unquote free, and you can take a strategy that some broker has probably developed for their own gain, and you can start using it. And let's say it's 90% accurate, or supposedly 90% accurate. And you go out and you might trade for your first week, or you might trade for your first few months, and guess what? You might make some money. Okay? You tell your friends, maybe you consider giving up work. Who knows? There could be all sorts of crazy things happening. So then what happens is you start to see a few losses. And they're absolutely natural. They're totally normal. Having a loss is just part and parcel of trading. It's what we do. We lose sometimes, but we make sure we don't get burned. So what we do is, you might have never experienced this. You might only have been having high accuracy levels. So what are you going to do when 6 losses come in a row? How would you feel, guys? What do you honestly think? You didn't see it coming. 6 losses just appeared in a row. How do you honestly feel? Because you've been building up in your head that you were now a trader, that your life was changing, that advertisement about living on a beach, it obviously wasn't a marketing ploy. It was apparently very, very true. How would you feel? Well, absolutely. You start to feel deflated. You lose faith. You're disheartened. You start to feel very angry, very annoyed, very upset. So what are you going to do? What do you think you're going to do? Well, your options really are to either stop trading or to become more aggressive. And many people will actually take that approach. What they will do is they will start risking more. Because what the problem is this word when. And this word when is a very dangerous word when it comes to trading. Why is this word so problematic? If we think about this, the trader is sitting there and they're saying that I'm going to risk more to make back my losses so that when the market turns, I'm going to be safe. So that's exactly what they do. They fight, and they fight with a market which is unequivocally telling them that they are wrong. The market is taking your money. You are wrong. But you're about to fight back. You're about to become more aggressive. It's no different than if you're in a boxing ring and you're asking for more punches and you're asking your opponent to take their gloves off and you're asking for your opponent to continue and to tie your hands behind your back. It's just not clever. Absolutely, Brian. It's like doubling down. The rare statistical event occurs, the whole strategy goes out the window and you lose. And how do we know that this will happen? Well, I suppose from working within the industry for many years, that absolutely helps. But just fundamentally, when you're in a professional trading environment, you have somebody called a risk manager. And that risk manager is constantly watching everything that you do. It doesn't matter if you own the company, you still have somebody watching your back. And that's because we're human. But you won't have that. The retail trader won't have that. You're going to trade on your own. You're going to try to convince yourself to change trajectory, to change path, to change a supposed strategy. because you need to amend it or you need to tweak it or whatever the case may be. But we know that this is the type of scenario which retail traders will face. So why on earth would you put yourself in the firing line? Negative risk-reward ratios or reverse risk-reward ratios, the same thing. They're dangerous for traders who are not sitting in a trading room. And furthermore, in terms of how they fit with us as people, we just don't like it. So that should give you a good feel for what type of approach we do ultimately like. And it most certainly is that positive risk-reward ratio. So going further than that, okay, we must start to think about individual and then overall exposure levels. We'll look at that in just a moment. Before we go through it, has anybody here ever come across martingale techniques? Martingale techniques for trading or for speculating or anything like that. We'll just briefly run through this if we don't mind. Okay, Anushka, good stuff. So martingale techniques, basically it's like doubling down. It sees the individual increasing the amount which they speculate each time that they lose. A lot of people do this, particularly in blackjack or some roulette or something like this. So when you get it wrong, you literally double down. You'll double your previous wager. And the idea is that when, again this word when the positive event occurs, it will help. And the reason why we're talking about this is because these methods are being pushed out into the world as if it was something new, as if it was not already known that they fail. Particularly in binary options markets and things like that. They're pushed out quite a lot. We really don't like them. Okay? So let's look at this. Let's say that you started out by risking $200 on your first trade. You lose, you go again for $400. You lose, you go again for $800. You lose, you go again $1,600. Then $3,200. Then $6,400. You're down $12,800 in a very short period of time. 6 losses. How could you afford to keep going? You simply couldn't. Why are we talking about this? We're talking about this because most of the algorithmic methods which exist out there, they use martingale techniques, especially with binary strategies and things similar to that. But you won't see that word being mentioned, but that is what's happening. Risking more when you're wrong is simply bad for business. So we're going to start to look at individual exposure levels. And just for ease of calculation, just for clarity, I guess, in all of these calculations, we're going to talk about an account size of $10,000. Okay? We're definitely not saying that this is the amount required in order to start trading. A lot of people would start with considerably smaller account sizes. The reason we're using this figure is out of convenience. It's a convenient number to use for all of our examples, that is all. So let's talk about the individual exposure levels that people look at. We liked the idea of using percentages as opposed to amounts. If you were using actual monetary terms, and a lot of our European clients would be engaged maybe in spread betting, where you might look at particular amounts, but we don't like that. When you're looking at using amounts, you might go out and you might say to yourself that you're going to risk, let's say, $200. If you had a $10,000 account and you were risking $200, that's 2%. But if you had 10 losses, your account would be down to 8,000. That 200 is then 2.5% of your trading capital. Okay? So you're risking a higher percentage level of your trading capital. So now you're wrong and you're also risking more, which is a bad idea. You're over trading. And what's worse is if the account was up, imagine the account was up to 12,000, you're now risking a smaller amount. You're under trading despite the market telling you that you were right. So we like working off percentage levels in all instances. So the next question which arises is, how much do you think is a reasonable amount to risk on each individual trade? Judy, absolutely, you're dead right. That's an error. But what do we think? What do you think is a reasonable amount to risk? What do we think? Let me have a look at what people are typing in. Okay, some 5%, 1.5%, 2%, 0.5%. Okay, most people, thankfully, are typing in pretty reasonable figures. Most people are typing in 1, maybe 2%. They're the type of levels which we are comfortable with. Now, you, I suppose, to give credit where it might be due, you've come through this educational program, you've spent a lot of time learning about the financial markets, you're on your 9th lesson, we've probably mentioned it once or 20 times, the types of figures which we would be comfortable with. But would you be surprised to know that most new traders risk far in excess of 10%? Far in excess of 10%. Okay? They would risk maybe 50% on a trade. And for anybody who thinks that this is the way to operate, we're going to show you exactly why it is one of the worst decisions which you could make. Let's do some examples. Let's imagine that you were risking 10% per trade. Okay? And you had 5 open positions and you had a $10,000 account. Imagine everything closed at the exact same time at a loss on the same day. Let's imagine everything goes against you at the exact same time in one day. Now, what is the value of your account? Where do you think it is? What's the new value of your account? Aligu, absolutely bang on the money. Tom, perfect stuff. Well done. Henrik, absolutely right. So the value on your account, absolutely, it's 50%. You're now down to $5,000. Are we all okay with that? Are we all okay with that? 50% loss, you're now down to a balance of $5,000. Now let's keep going with this role-playing scenario. How would you feel if you came home from work and half of the money in your account was gone? How would you feel, guys? What sort of word would you use? You've just opened up your trading platform, you've looked at your account, and it felt like the largest man in the world has kicked you in the sorest possible place. That's exactly how you would feel. You would be angry, to put it mildly. You would feel a little ill, okay? Do you then think that to generate a 100% return just to bring your account back up to where it started from, do you think that would be a walk in the park? Do you think generating a greater return than most professional traders in that horrible situation, do you think that would be easy? Do you think it would even be possible? And the answer to all of those questions is absolutely not. Okay? Absolutely not. You cannot operate with that level of risk and then try to claw your way back with that level of emotional stress. It's just the end of the road. And it was all your fault. You took too much risk. And guess what happened, guys? You paid professionals. You paid us. You paid people who don't take too much risk, who do protect themselves. You made us wealthy by you risking your money recklessly. And, you know, when we talk to traders, and if you come away from here and you just appreciate that if you risk 10% per trade, you would be better off going out the back and taking your wallet and setting it on fire and just watching it burn. Because that's exactly what will happen. At some point, that will certainly happen at that level of risk. But the good thing is, because we're impartial, we're in a position where we're actually able to say it honestly. So what's the solution? Let's not all be negative. Let's do the same scenario. If you were more responsible, and if you went out and you risked 2% per trade on a $10,000 account, and you've got 5 losing trades, that totals up to a 10% hit. You lose 1,000. It's not a great day, but it's not the end of the world. It's not the best day you've ever had, but you can survive it. Okay, you wouldn't have to bring in a 100% of a return, you'd have to bring in 11% of a return just to get back from where you started. By no means would this be nice, by no means would this be something that we would be happy with, but the issue is that it is achievable. It's absolutely achievable, Gus, and it's manageable, absolutely. So this is what we like. We must know what we are doing in these types of scenarios in order to protect ourselves and to really, I guess, just help ourselves. So let's have a look at this a little further. We say 5% is far too much. We say the lower the better, 2% or less. And how we do this is through position sizing. Okay, through position sizing. And we've spoken about this on and off leading up to this point, how to structure a position size. What we're now going to do is we're going to have a look at this area a little bit further. There will be a little bit of maths, but it's quite straightforward. Well, hopefully it is. And the recordings obviously will be available as well for tomorrow. Maths is nothing to be feared. It should be something which we should all in some way enjoy. So let's have a look at this. Let's start out and let's say that you've got a $10,000 account, you're risking 2% per trade and you're looking at euro dollar. The amount that you've decided you're willing to risk is $200. That's just 2% of 10,000. Okay? Now for this part, we're going to run the webinar maybe a little bit like we might run our ultimate side of things, okay? So really to make sure that we're all on the same page, I'm going to ask you to type the letter Y for yes when you're comfortable and N for no if you're not comfortable. Okay? So it'll help me to understand whether or not somebody is lost or if we need to go over something again, okay? So 2% of a $10,000 account is $200. Are we all good with that, guys? $200. No issue there, I hope, or else we're in big trouble. Okay, good stuff. Now the next question which comes up is what size stop loss must we use? And that's not an easy question. That comes from your trading strategy. So we need to be a little bit hypothetical. So it comes from a trading strategy, the one that you've built or one that you've purchased, but your stop loss will come from your strategy. For the purposes of this example, we're going to say that there is a 100 pip stop loss. Is everybody okay with that? Just for this example, we're going to say that we're going to use a 100 pip stop loss. Okay, so what we're saying, if the market goes against us by 100 pips, we want to have risk no more than $200. Okay? Okay, looking at all the Y's, great stuff. Francois, you have it, absolutely. Okay, so we're going to work this out. We need to ask ourselves, what is the pip value? Keith, you're ahead of the pack. Well done. What is the pip value? What is the movement per pip? So we must say to ourselves that we're willing to risk $200. That's the monetary exposure. And we want to divide that by our pip exposure, our 100 pips. So for each time the market moves by 1 pip, we would be willing to risk $2. You divide the monetary exposure by the pip exposure. ME over PE. Monetary exposure over pip exposure. Are we all okay with that? Reasonably straightforward. Monetary exposure divided by pip exposure tells us how much we are willing to risk on each increment of change. Brilliant. Now that gives us an important piece of information. And we're going to slot that piece of information into another formula. Okay? And what that formula is, this one formula right here, I'm just going to put an asterisk beside it. In any trading environment that I've ever been in, I would encourage anybody and everybody to just remember or write down this formula and put it on your screen. You know, put it on a post-it, stick it to the side of your screen. It answers just about every question. It's just perfectly useful. Okay? So we have trade size equals pip value divided by pip location. Now, when we look at this, for euro US dollar, we should know what the pip location is. What is the euro US dollar pip location? The smallest increment of change, Nushka. That's the pip location, the smallest increment of change. It's a decimal place. It's 0.0001. The fourth place after the decimal point. It's been a while since we covered it, way back in lesson number 2, if memory serves. But remember, the pip location for euro dollar is 0.0001. It's the smallest increment of change. So we already actually knew this piece of information. It is always this for euro dollar, Ninja. Absolutely. We know this information. We knew that bit. And we also know the pip value. We've worked that out already. It's $2. So we just put it in. So the pip value is $2. We divide it by the pip location, divided by 0.0001, and it gives us an answer of 20,000. Matthew, absolutely right. So the trade size is 20,000. This is the notional trade size. If you put on a trade size of 20,000 euros worth of dollars with a 100 pip stop loss, you're trying to cap your loss to $200. Does that make sense to everyone? You're trying to cap your exposure to $200. Now, the missing part of all of this is how big the stop loss one should or could use. Okay? And again, that's where your strategy comes into its own, comes into its element essentially. Okay? These pip locations, for the majority of FX pairs, it is 0.0001, natural gas is 0.001, gold is 0.01, but it is information that is available from your broker's website, typically under trading conditions or trading terms, or something similar to that. Okay? So let's do another example, this time for gold. And we'll try and do it in the exact same way as previously. Type in your Y's when we're all together. Type in your N's if there is any confusion. So again, we're going to use the same numbers. $10,000, 2% risk. We're going to risk $200. And we're going to imagine that our strategy is going to suggest a 500 pip stop loss. Okay, a 500 pip stop loss. Now that's only a $5 movement in the price of gold. It's quite small. What we then must do is take the monetary exposure of $200 divided by the pip exposure of 500 pips, so you get 0.4. That's the value that we would be willing to risk on each increment of change. Everybody okay with that? That's how much we're willing to risk on each increment of change. Now we know the formula is trade size equals pip value divided by pip location, so we put 0.4 over 0.01, so we get 40. So what is that 40 in this instance? What is that 40? That's the notional trade size. What this 40 is, Alan, it's 40 units of the market which we are trading. And gold is traded in ounces. Absolutely, Dale, you have it. Well done. So it's 40 ounces of gold. If you traded 40 ounces of gold with a 500 pip stop loss, you would be trying to limit your risk at $200. Is everybody okay with that? Does that make sense to everybody? All comfortable with that? What do we think? Okay, I'll tell you what, why don't we have a look? There's a couple of N's coming in. Why don't we have a look and see exactly what it might be like if you were using our trade sizing software. These calculations, they're not something which you should ever have to go through each time that you would go about placing a trade. So would you like to see it on our software? I'll tell you what, type the word TS, or the letters TS, just TS, if you want to see it on our own trade sizing software. And if there is enough demand, I'll take a minute or two just to show you exactly what this would be like and how it would show you where to place your stop losses. Okay, there's a lot of TS's coming in. Okay, if you just let me see if I can do this on the fly. I was somewhat prepared for this evening. Let me see if I can just get this up on screen. Okay. So this here on screen now, if I can just maximize it. Perfect. So this is our trade sizer. This is a part, just one portion of it. You can see along the top we've quite a lot of tabs. We won't go into these tabs now. We'll just go into the pending order section. and of it set up so we're looking at gold, at this gold chart, or not a gold chart, excuse me, at this gold market. So let me just get out my pen so I can just make sure everybody can see what I'm looking at. Okay, so we have a number of tabs running across the top banner up here. What I'm looking at specifically is this pending order tab where you can see the name right down there. I've already set it up where we're looking at the gold market in particular. Okay, this element here, this is just if I had an account that was denominated in anything other than dollars, it would convert it into dollars for me because gold is traded in dollars. So all I need to do, I need to put in a value. I'll put an X where I want to put in a value. X right here is where I want to put in a value. And I'll put one in this box here at X. Okay, they're the only two places where I need to put in values, and that then will give me my trade size, and it will also tell me where I will put my stop loss. Okay, so this would be part of the strategy, Tatiana, or excuse me, Robin, this would be a part of the strategy. This would be what tells you where to put in your stop loss area. So the volatility, that's just the intraday movement. Okay, that's what we look at, the volatility side of things, which helps us dictate where we might want to place our stop loss. So with this volatility level, basically what I'm saying is that gold has been moving on average of $10.10 per day over the previous X amount of days. And when I say that, you can see, if I just get out my highlighter, right over here, that the trade size area has now been populated. So it's telling me with a volatility level of gold moving $10.10 per day on average that I can trade with a trade size of 0.54 of a lot, which is 100 ounces. And we can also see that this is tied with my risk even being below 2%. I have the risk set at 1%. So this is automatically telling me for me to risk only 1% of my total trading capital, that my lot size, my trade size has to be that I'm trading 54 ounces of gold. For my stop loss, what I need to do is I need to put in my desired price. So imagine if I wanted to enter at $1,100. Imagine if the strategy was telling me that that was an ideal entry point. You can see that once I put in that figure into the ideal entry point area, that it automatically populates where my stop loss has to be. So I have all the information which I need. Okay, I have all the information. I have my risk side, which I have dictated beforehand. I have the volatility, which I take from the chart. Once I pop those in, it gives me the size of the trade. Once I put in the level which I want to enter at, it automatically provides me where my stop loss should be. So I have every single piece of information so that I know how much I need to risk in each instance, so that I'm never going beyond my predefined percentage level of risk. You can set this risk percentage level at any rate that you want. Absolutely. If I want to drop it to 0.75, I can. If I want to increase it to 2, no problem at all. Okay? So you can do it any way at all. So Dieter, that's absolutely right. With 1% risk, at a lot size of 54 ounces, my stop loss is $1,079.80. I'm not going to risk any more than 1% of my total trading capital. That's what it's telling me. Okay? If the risk goes up to 2%, it simply adjusts everything. The lot size doubles. So twice the trade size, the same stop loss. You can tell automatically that you're risking twice the amount. So that's, I suppose, just a quick snapshot. I'm trying not to confuse the issue even more, but that's just a quick snapshot maybe of the type of software which we use in order to manage our risk. And of course, the stop loss would say the same, Nushka. If we're doubling our trade size, it means that we're increasing the level of risk. Okay, if we're doubling our trade size, it means that we're increasing our risk. So that's an example of how to manage your risk, I guess, in a more efficient way without having to go through these kinds of formula every time. Okay? So that's that done. We can look at the same thing with crude oil, where we go through those exact same kind of calculation. we go through those same types of calculation and we can figure out with crude where there is a stop loss in place of 400 pips where we want to risk $200. It tells us the amount of barrels of crude, the number of barrels of crude oil which we want to risk. So it's the exact same type of calculation. We like you, I suppose, to understand the processes involved in figuring out exactly where the stops should be, but you don't really you just have to understand the processes involved rather than having to go through those kinds of calculations over and over again. But individual calculations or individual exposure is absolutely fine. You also need to be very aware of where your exposure needs to be in an overall sense. How much would you be willing to risk overall? If everything that could go wrong in your entire account did go wrong, how much would you be willing to risk? If every single trade which you had hit your stops at the same time, how much would you be willing to risk? All of your trades, all of your positions, all at the same time. It will happen someday. It happens to everybody. What would you be willing to go for? A lot of people typing in, what have we got? 5%, goes 50%, 5% per day, Tom. Okay, if you were trading with something like 2% risk per trade, you'd probably be exposing yourself to in excess of 20% risk if all of your orders filled and then got hit at the same time. For our own trading, we try to keep our risk in total down below 5%, ideally even below 2.5% overall, because that allows us to survive. It's not a pessimistic approach, because when you talk about protecting yourself and when you talk about planning all of this out, it's not because everything is going to be terrible. It's because of the beautiful fact that you know that the other trader who just saw the advertisement, who just opened up an account, they are not doing this. They're just out and they're listening to some of these tips or advice and they're just risking more. You're just working harder than the person beside you. You're working more intelligently. That's all you're doing. And we put this all together. Okay, and we say that 2% could see you having 20% overall. We like having much less than these sorts of areas. We also need to have a quick talk about spreading our risk. Because throughout all of these lessons, we've been speaking about what sort of entries we're going to use and all this sort of thing. But a key area which I picked up on in terms of my own career within the hedge fund community was the idea of spreading risk. You actively go out and you find areas of risk. That's actually what you're doing. You're spreading it around. So you can look at currencies, you can look at energies, you could look at softs, you could look at metals, you could look at different currencies. Whatever the case may be, you're spreading it around because they won't all be going in the same direction at the same time. So it's a way of protecting ourselves. So that's what we're looking to do. We also have to watch out for markets which might be linked very clearly. You might find something like the euro dollar and sterling dollar, both of them having that dollar element. They would move quite similarly a lot of the time. The same with the commodity sector, gold and silver. They tend to move the same way at the same time. The same with the different oils, crude or Brent. The same with interest rates or bonds. They would tend to move very, very similarly as well. So we need to be aware of these kinds of issues, and they can help with our trading. And we'll be looking at this a little bit later in this final class coming up in 2 days' time. But when we think about trading, we need to look at what markets we need to focus upon. You want to look at markets which you are comfortable with. And you need to be aware that the cheapest is not necessarily the best. Okay? There are brokers out there who will give you no transactional charges. Do you think that it's a good idea to trade with a broker who will not look for any transactional fees? What do we think? Do we think that might be a useful way of spending time? Do you instead maybe believe that if they're not charging you fees to trade, then they're going to try to generate revenue from you in some other way, aren't they? They're more likely a market maker. They're more likely taking the opposite side of the trade. They're more likely relying upon you to fail and not really interested in your interests. So what we want to do is we want to use our common sense in order to trade the markets a little bit more efficiently, a little bit more effectively, and by trading with the right type of broker. That's massively important. It's something which we all need to realize. And by using these diversification elements, by being aware of correlation, by having a portfolio which is quite broad, it's important to use these types of things to spread our risk around, to help yourself, to improve the odds of you gaining. Okay, of helping yourself to trade not like a retail trader, to trade more like a market maker, because that's what we're here to do. You need to have as broad a range of elements, as broad a range of markets to access in order to help to make sure that you're not going to be stuck in one small portfolio. So that's massively important to point out. So you need to make sure that you manage yourself correctly. Okay, if you're trading crude oil, you need to know the basic things about it. You need to know that you're trading barrels. You need to know the facts about it. If you're trading gold, you need to know that it's ounces. Okay, just the areas which make you feel more comfortable. Okay, because knowledge is certainly the key. Knowing what you're doing, knowing everything about it, that is what is going to make the difference. Now, before I finish up this evening, I do know that over the past few lessons we have been showing you the odd chart where you saw our own ultimate trading indicator on it. So I have pre-prepared a kind of a tangent number of slides. If you'd like to see our Ultimate Traders Program indicator in action, please type in that word show and you'll see exactly how we find entry points which we can then slot into that risk management software which we gave you a brief viewing of earlier on. If you'd like us to do that, please type in that word show. We're just a little over the hour mark now, so hopefully we're not going to take up anybody's time. If we are to do it, you're not going to feel like I'm taking up from your class to show you this. Okay, great stuff. There are quite a lot of shows coming in, which is good to see, but it is important to point out that by using our indicator, we're not trying to trade our opinion. We are never interested in our opinion. We're never interested in the why behind what the market is doing. All that we are interested in doing is we're interested in the price, we're interested in momentum, we're interested in jumping on board a market which is moving at the earliest possible opportunity and then following that market, using the momentum in order to realize profits. So we just use what we've already spoken about time and time again. We see the price, we accept what it's doing, and we trade the price. We're never reliant upon our own opinion. So when you look at a market like this is a gold chart. Well, I guess it's a gold chart from towards the end of last year. And can we look maybe, or even maybe type in a date or type in a price as to where you would have maybe liked to have entered? What do you think? Where would you have liked to have entered? Give me a price point, give me a direction if you wish as well, if that makes sense. But what would you have liked to have done looking at this chart from just the end of last year? Okay, so there are a lot of people, let me have a look. There are a lot of people saying that they would have liked to have gotten in at the early part of December and caught that little bit of an upward movement. I can see that, that's all right. But what about this downward movement here? Wouldn't it have been nice to have been part of that, to have shorted up at the level close to the top and seen that fall in price? But you see, the point is that when this rise beforehand, when this rise in September into October of last year was taking place, there were a lot of bullish traders out there saying that the market was taking off, and it was a clear indication that there was inherent strength in this market, and we had seen the lows, and there was going to be no further sell-offs. And this level here was part of the low, and because this level here was a higher low, it meant that the market was moving in that upward trend. But the thing is, the point is that we are not reliant upon our opinion, are we? We're not looking to figure out what we are thinking. Okay? We didn't know the market was going to break down. Absolutely not. All that we knew is when the price came down and when it hit our indicator, it told us to enter. It told us to enter to the short side of the market. And it told us to enter right at, let me get out my pen again, right at this level here. Okay, so we look at it back in October of last year. This is one of our indicators, one of our strategies. When the price hits the blue line, we enter. We don't look for any other signal. It's an unambiguous signal to enter. It signaled to sell the market. And then we exited when it hit the opposite red line. So that's our exit signal. Again, an unequivocal signal to exit. So this is between entry and exit. Even though it might look quite shallow, it's just $50, but $50 in gold resulted in a 5,500 pip movement. It's quite substantial. So that blue line, that's part of our own proprietary software. That's one of our indicators. It's one of our Ultimate Traders indicators. The blue line and the red line, they are part of one set of strategies which we use. One of two strategies which we use. Let's have a look at the other strategy. Let's have a look at Facebook. The same thing will apply. This Facebook market, it was trending sideways for 3 months. And when a market is trending sideways, people get very fearful about when to enter. The market is most likely moving in a range. It most likely has been moving up to a ceiling and down to a floor. People tend to lose confidence as to when there might be a breakout. But looking at it, again, we're not reliant upon our opinion. Luckily, we have the indicator which tells us where we should enter. So when it hits one of our lines, it's a clear signal to just get in the market. And we can see where it hit this line. This is our other strategy. It hit our black line, and we did not get out until it hit off the opposite blue line. So what has happened right now is only at the start of this year. Was it the start of this year? I think it was actually on New Year's Day, if I'm not mistaken. But that was the point in time where we got out of this market. You might think that it's a relatively shallow move, and you know what? It does look a little shallow. It's only a few dollars, but it was still a gain of 2.77% in this particular market. And at 2.77% over the space of what? Just under 2 months? There's absolutely nothing wrong with that. If you think that for every single trade that you were to place, if you were to achieve a return of 2.77% for every single trade, it would not be a bad year whatsoever. So this is, I guess, an idea of that profit maximization. Even though the market was moving sideways, moving up and down at this level, we do not enter based upon we do not exit based upon our opinion. We only exit when the actual software tells us to, when the indicator tells us to, when the price comes down and reacts with one of our own proprietary lines. And I think that's what is massively, hugely popular. Michael, you're asking, why do we wait? We don't really wait, Michael. We just give the market room to breathe. We have to wait for the trade to come to its natural conclusion. We have to, if you like, be a little fair to the market. Okay, we have to let it reach its natural conclusion. We'll only exit when it tells us to. This isn't a trailing stop. This is a loss which we would move on a manual basis, day in, day out. So a quick summary. In order to be successful, You need to be aware of the risk. You've got to manage your risk. You've got to know individually and overall how to operate. You've got to have a full trading strategy. New traders typically do not have one. New traders, they expect to learn how to profit for free. They believe that they can do it alone, that it's that easy. And it's a little bit like waking up one morning and thinking that you are going to be a brain surgeon today. You can think it, you can go out and try to get patients, but it's unlikely that it's going to end very positively. You must plan what you're looking to do. You must always plan what you are looking to achieve and prepare yourself accordingly. And once you know the basics, once you know exactly how the financial markets work, then you can begin operating within the marketplace. You need to figure out how much you're going to financially trade. You need to figure out where you're going to place your stops. You need to figure out when and where to adjust your stops. They don't cost you anything to adjust, absolutely not. You need to know how many trades you're going to place in the market at any one time. You need to track your performance. And we need to eliminate that.
Now, I'm not saying I don't like kids. I like kids. I have fun hanging out with my friends' kids and joking around with them, whatever. They're great. But I do feel like when I talk to my friends that recently had kids, it does seem like they had to give up everything for the kid. And that's very scary. If you want to have a depressing conversation, talk to a couple that just had a kid. Ask them about the last night they went out for themselves. They will describe the most boring, typical, mundane evening out.